what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy or refinance your house in Dallas, Texas in 2026 and you're self-employed, maybe a 1099 contractor, and it's time to file those income taxes, but you're not sure what expenses to take, what to show, because obviously that's got a lot to do with you being able to qualify for a new home loan. Stick around. In this video, I'm going to teach you everything you need to know. Listen, income tax season is here, for better or for worse. For all my self-employed business owners, 1099, contract employees, we all know that obviously these types of clients and borrowers make money. They just don't always show money. They maximize as much of the IRS code as possible, take as many deductions as possible to help limit their tax exposure, which is a genius idea. You're allowed to do it, but sometimes taking those expenses can have your income and your bottom line, adjusted gross income, show a lower number than you need to qualify. So what do self-employed people do? Hey, I want to buy a house in 26. It's time to file my 25 taxes. I don't know what to do. I don't know how much to qualify for. How much of my expenses should I take? Should I not take? If I don't take this many expenses, I might owe Uncle Sam some more money. If I do take the expenses and I don't pay Sam, I might be able to buy a house. So where do we go from here? Well, first and foremost, my recommendation is obviously to always get with a tax accountant, a professional to help guide you when it comes to filing income tax returns and obviously maximizing the tax deductions. Now, two things I want you to realize when it comes to filing self-employment income taxes and qualifying for a home loan. Number one, if you've had the business, been in the business, been an owner of the business for more than 5 years, same business in existence more than 5 years, we only need your most recent 1 year of tax returns. So let's say, for instance, you had a business for the last 8 years. I can actually use 2024 tax returns if they look better than 25 and you file an extension. Let's say you didn't file an extension, you're like, hey, it's time to file the 25s. So we could take the 25 tax return, divide it by 12 months, and obviously we use that as your monthly income. Sometimes, obviously, you don't take as many deductions. You owe Uncle Sam a little bit more money, but hey, if that's what it takes to obviously qualify for a home loan, sometimes it's what you gotta do. But that doesn't mean you always have to do it. And the two trains of thought on this are really kind of up to the bar, but I would encourage you to think about it like this. Number one, full disclosure, I am not a CPA, a tax expert, so this is not advice. These are just things that I know from being in the business and I've seen from doing home loans. Tip number one, there are hard expenses, there are soft expenses, and there are obviously one-time costs. Now, all of these expenses fall under some type of IRS code that allows the consumer to take these expenses to knock down their gross income to get to adjusted gross and obviously limit the tax exposure. But not all expenses and costs are the same in my world. There are hard costs and soft costs. Let's talk about the soft costs for a minute, because these are the ones that people take that help bring their taxable income down, but lenders understand these are just paper losses, and so we're able to add them back. First and foremost is depreciation. So for an example, let's say you had an income producing property. Let's say you made $2,000 a month in rental income, but you took bonus depreciation or depreciation on the property for $50,000, $75,000, $100,000. That would show that, of course, you would take a huge loss on that property. That would affect your overall income. But we as lenders know this depreciation is a soft cost. So depreciation is one of the soft costs. We just go and add that back. So if there was a $75,000 depreciation that resulted in a loss, whatever that loss is, we add $75,000 back to that. And a lot of times that'll flip the income and bring it to a positive, and we can use that positive income divided by 12, and that will give you enough money to qualify for the loan. Now, as far as what soft costs and hard costs are out there that you can or can't take, obviously contact your local tax expert. They can help you with that. The soft costs are really important. Second thing is one-time expenses. Sometimes people will have costs associated with a business, but it is a one-time expense, meaning it's going to be non-recurring in the future, unlike payroll, unlike gas, unlike mileage. Every now and then somebody will have to do something with their business that is expensive. It will be a hard expense or an expense on the tax returns, but because it's non-recurring, we can also remove that. Now, what are those expenses? It depends upon what business you're in. It would be required to get a letter from your accountant saying that this is a one-time recurring expense, but we can add that back. However, things like one-time non-recurring expenses and soft costs help you, the consumer, limit tax liability, but we as lenders can add all that stuff back, and sometimes, again, it flips it to positive income, resulting in positive income for you and enough income to qualify. So that's part one. Part two is, if you file your tax return and you owe Uncle Sam some money, you have the option to do two things if you're buying a house. Let's say hypothetically, for an example, you filed an income tax return, you showed $100,000 in income after all of your deductions, and you owed Uncle Sam 15,000 bucks. You have two choices. The lender's gonna ask you to do one of the two. Number one, stroke a check to Uncle Sam for $15,000 in full, show that it's paid in full, done and cleared, so there's no more liability, or you could get on a payment plan. You can take that $15,000, get on a payment plan, probably 72 months, make the payment $200 or $300, and then we take that monthly payment, add it into your total debt to income ratio, and as long as you can qualify with that payment plan, you make at least one payment, you can do it that way as well, so you don't have to come out of pocket so much money. Third thing is, sometimes people don't want to limit themselves on deductions. So always remember, we have alternative loan programs for self-employed people. We've got 1099 programs, bank statement programs, P&L programs, to where we will use alternative documentation to document income in lieu of the tax returns, or whatever the adjusted gross income tax returns, to help you qualify. Yes, the interest rates are slightly higher on those programs. However, you may not have as much tax exposure when it comes to filing your income tax return. So you have to look at the overall side-by-side comparison for you and say, hey, do I want to take less deductions? Do I want to pay Uncle Sam 15 grand? Or do I want to maximize my deductions? My income might be half of that. I may not qualify the traditional route. But if I take a loan over here and the interest rate is 1% higher, and that's an extra $200 a month in the payment, times 12 months, that's $2,400 bucks. If you had no tax exposure versus $15,000 tax exposure, and it was $200 a month times 12 months, that's $2,400 a year versus the $15,000 up front, it'd take you a while for this $2,400 extra to catch up to the 15. So sometimes from a money standpoint, it's actually more advantageous to maximize all your deductions, take a portfolio style loan, a non-QM loan that we do, a little bit higher on the rate, a little bit higher on the payment, but you get the best of both worlds, which is qualifying for the house, being able to maximize the deductions, and not having to pay Uncle Sam, and that money goes to something else, which really is towards your principal, towards your interest, and towards your actual home and investment. So always advise with a tax consultant before you make any moves. Figure out what can and can't be done. If you're self-employed 1099 and you're looking to qualify for a home, you can always get with me, and you can always send me a copy of the prepared returns before you sign them and execute them and send them into the IRS, so I can make sure that whatever income you're preparing to file with the IRS is okay on my side. Sometimes if adjustments be made, you're free to adjust it. I can't advise on that, but I can definitely take a look at the drafted copies before you completely file. So hopefully this information was helpful. Tax season is not great for anybody unless of course you're expecting a huge refund, but it is crucial and highly important when it comes to qualifying for a home loan. If you got any questions about this, pre-approval, home loan journey, or anything at all, do us a favor, call us, email us, text us. We're always here for you. Until next time, stay tuned.